let's just dial back a little bit before we get into the details of risk management and the way I approach trade management, right? So you can risk when it comes to risk management, it is all about the percent or percentage. It is all about the percentage. It is all about 0.5% or the risk management. That's risk management. When we're talking about money management, that is the overall compounding of your balance, of your trading balance. And when we talk about trade management, it is about how you manage your stop loss within a trade and how you manage your profits and how you manage everything. But before we talk about the trade management aspect, I want to first dial back into our model, fully describing it to the point, because we're going to also go in depth in the next lectures about the institutional order flow signatures that I've promised to you. So, our model is as follows. I'm not going to talk about the monthly chart yet and about the profiles that I have found inside of the monthly chart inside of this here, but I'm going to talk about something that you already know. So, our analysis starts on a weekly chart. Of course, you can have a 12-month direction, and do not try and, just predict every singular tick from the 12-month chart. Do not try and predict the high, the low, and the close, because that's irrelevant. All we need to do is have an idea about the direction. But you do not even need a 12-month chart. So all of our trading is based on the highest time frame yet, the weekly chart. And inside of this weekly chart, what we're going to do and what we're going to analyze is going to be based on a seasonal tendency. A seasonal tendency is, you already know what a seasonal tendency is. It is a roadmap. The market usually does this. The market usually creates a high throughout May. Then what we do with that seasonal tendency is we look at the market and we identify the market structure. And we identify the current PDRAs and the likely direction of said seasonal tendency. So for instance, if I'm looking at the chart and I know that the seasonal tendency is going to be for the market to go higher, I'm looking for signs that the market is going to indeed go higher. And I will want to see the market leave those intermediate term lows as means of intermediate term lows, and I want to see the market use bullish order blocks as bullish order blocks. I want to see CBIS fail and turn into inversion gaps, and all of these signatures that you already know, or you're going to know. This is how we frame our weekly bias and narrative. Then, once we have a weekly direction and how we want to see the market trade, we're going to then look at the economic calendar, because we know that the market does not only open and go higher, the market has to also create the opposite range of the opposite low or high of the range. So this is the accumulation, manipulation, distribution concept. We want to see the market higher, but first we want to see the market go lower. When do we trade for the distribution part? We trade on it based on anticipating the market to manipulate prior to a high impact news driver event or within the high impact news driver event, because retail traders are very emotional. So we already have a direction. We already have the days in which we want to trade based on a weekly profile. For instance, Wednesday is going to be on Wednesday. CPI is going to be on Wednesday. We never trade, we can trade Monday, but essentially we do not want to trade the day ahead of CPI. I would not even trade Monday. I would just let it be. And the best time to trade is after CPI. And within CPI, we want to see a fake movement to the downside if we're going to indeed see bullish price action throughout the week. And we then will see more likely the distribution part of the week, which is the sweetest trading that you can have. and it is very one directional and very easy to see. Now, within the day, we also know that there's profiles because the AM session can go higher and it can go higher with speed, and then your PM session is going to consolidate. That is a profile. We also have profiles again for the week in which anticipate them based on a high impact news driver. Now, our model of choice instead of the session, instead of our daily anticipation. So let's just say, for instance, that the low of the day was made in London. We've had a rally throughout the AM, and I'm going to draw that out right now. So open, market goes lower, we go higher throughout the AM, market consolidates, goes lower below the level of sell stops throughout the lunch session, and then your model is for a continuation higher. If this happens, then what we're going to do is you're going to have a model which is based on the lunch sell side, lunch buy side, and you are going to enter within the not 950, but X50 to Y10 macro, or this is suitable for everything. If you're trying to trade the AM session, it's going to be 950 to 1010. If you're trading the PM session, it's going to be 150 to 210. Now, everything has been explained. This is all the details that you need. Of course, we're not going to talk about the specifics, about the market structure, about fair value gaps. I'm not going to talk about these things. But what I want to talk about is the trade management. You did everything until this point. You've identified all of these signatures that you want to see. You have seen the market structure shift between 150 to 210. And let's see what we do right now. So let's just take a bullish example. This is the market going below a level of sell side. And this is our macro market structure shift, right? We are going to also have a target, which we're going to look for the daily chart or for a very higher time frame chart. And what we're going to do right now is we're going to frame our targets. So we already know what we're going to look for. And we're going to use this, as you've known within the last year, we're going to use this as a means of a draw on liquidity. So let me just draw this out for you. All right. Sell side liquidity. All right. This is our macro daily target. So this is a target that we want to see for the day, not necessarily for the session. All right. There's usually going to be some level of inefficiency or intra-session target, some very high target, but it can not be hit throughout the session. So this is a very far away target, but yet it is achievable throughout the session. And the next one is the achievable, let me just say this, low hanging fruit target. All right. So we had successfully seen our market structure shift. Our model implies, well, first of all, let me just go throughout the important things because I forgot to give out the logic. We know that when the market goes back below a level of sell side, this is where smart money accumulates what? Longs. We want to see smart money, of course, distribute the longs above inside of an inefficiency or a liquidity pool. Right here, what we see is the market going up, the market failing, or it can also go below this low, but it is irrelevant right now. The market goes back into some form of a fair value gap, or of course an order block if your eye is trained to see an order block. And then what we see here is a market structure shift. Let me tell you what we do now. Well, first of all, I don't know if I talked about this with you in depth, but what a market structure shift is, basically it is a shift between a sell program into a buy program. So we were going below for levels of sell side. The market, as we've taken this swing high right here, the market had successfully shifted. So now what we're going to see is we're going to see bullish price action. But this is not a long-term market structure shift. The market can also shift, go into some form of inefficiency above here, and then it can continue lower. So a market structure shift is a sign that the market has shifted from bearish to bullish or from bullish to bearish. In this case, we're going to look for bullish price action. The reason why we do not want to see price go below this low, and the reason why we choose a fair value gap which is favorable to be around this high, is because this low here was created for the sole purpose of repricing back to some form of inefficiency. And as we leave it and we take on a short-term high, this is going to be what? A balanced price range. So therefore, the market has successfully done its job to go back for this inefficiency, to rebalance it, and we left it. So what I anticipate is for the market to now retrace into some form of a fair value gap. What we're going to do now is, let me just zoom in. And I'm going to show this in the chart too. So, shift, the market has went below a level of sell stops. This is where smart money accumulates. So there's no reason for the market to go here. So we first have our fair value gap in which we're going to enter either at the high or the 50% or even the low. And our stop loss is going to be placed below the third PDOA. This is the rule set that we use also for a stop loss. For example, fair value gap, there's going to usually be another fair value gap here, which is most likely going to be a breakaway. Why? The reason why is exactly as I've told you. The market has no reason to go inside of this dealing range because we have done the job. The job is fulfilled. Market goes back into some form of a fair value gap. The second fair value gap is going to be here, which we want to see open, and I've told you why right now. And then we're also going to have some form of an order block. So therefore, if I'm going to long here, I do not necessarily need my stop loss here. Where I'm going to put my stop loss is going to be the order block, and I'm going to put it below the mean threshold. And the reason why I say below is because the market can go back to the mean threshold, but we do not want to see the market close below it. If the market goes, in this instance, below the mean threshold and it closes below it, then I want to be out. Because this means that the market is going to go into this low. And if the market goes into this low, I'm telling you that it's going to just rally to the downside. And you want to have a stop loss. So if we long here, our stop loss is going to be below the mean threshold of this here. So you can put it below the order block or at the closing of said candlestick. So This is our stop loss placement. Let me just draw this out for you so you can take a screenshot. All right. Market structure shift. I'm going to also put a premium discount to this. I'm going to understand why in a second. All right. So first fair value gap, we're going to assume that there's a second fair value gap, which is most likely going to be a plus breakaway. And the third is going to be some form of an order block, plus OP. What we're going to do right now is we are going to aim for something which is very low to achieve and very easy to achieve. In your current development, you're going to only target this, and this is where you're going to exit. When you get more advanced and you are going to use more contracts or more lots, if you want to call them like that, then what you're going to do is you can take most of your position off here, and we are going to aim for the next target. And the next target can be this or some form of standard deviation that goes above this. And then ultimately we can let the market run for the macro daily target. But in our current case, what we want to see the market do is we're going to aim for this level of buy side. So we're going to see the market do this, and most likely it is going to continue higher, close above some form of a inversion gap here. It's going to be made an inversion gap after we close above it. It's going to be reused, and then we're going to see the market go higher. Now, when do we trail our stop loss to a break even? Well, if we're going to aim for this target, I'm going to remind you of the concept of the implied dealing range. So if we're going to talk about the implied dealing range, we're going to talk about the following. The implied dealing range is the distance or the range between the lowest point of the current dealing range and the target that you want to achieve. So again, this would be essentially the implied dealing range. And the reason why this is an implied dealing range, it is because this range right here, this price action right here, it is not yet achieved. It is not yet in price. This is implied. This is not yet happening. So we want to see the market go here, but this is the dealing range that's available. If I'm going to target for some form of a macro daily target, I'm going to aim for this as my implied dealing range. And let's assume that we're going to aim for the intra-session target. My stop loss is going to be moved when the market reaches some form of buy side liquidity. So the market is going to continue higher, and then it usually just, after this one, it usually just goes straight up higher. This is when my stop loss is going to be trailed to break even, and I'm going to take most of my position off. Right, and then the market, what will usually do is it will create some form of, the market will create some form of consolidation or even a retracement. So we anticipate the market to take some form of sell side. That's why we do not trail our stop below this low, because that's what retail traders do, and that's why they lose, and that's how they lose. And our new dealing range is going to be from this low up until this high. So if we want to trade and we want to move our stop loss beyond break even, what we're going to do is from this price point until we have made this high here, we're going to measure the first, the second, and then the third PDRA. And yet again, you're going to move your stop loss below the third PDRA, below. So if it's a fair value gap, I'm going to have it at the low of the fair value gap, or the opening if it's a bullish fair value gap, right? The market will usually do this thing. And when the market does this, if you want to be more aggressive with your stop, because we have already taken a level of sell stops, the market went back into some form of a busy, rebalancing it after we left it. So this becomes what? Balanced price range, dealing range. We had taken stops. We went back into a fair value gap. We went away from it. Balanced price range. So the market should not go below this low. When the market goes higher, where do we place our stop? Below this low. Market will see some form of retracement and usually into your target. And this is how you do your trade management if you were to aim for the intra-session target. And also if you want to aim for a macro daily target and you've had everything in terms of the weekly bias, the daily bias correct, then you're just going to move your stop loss to break even and you're just going to let it go, because you know that this is the sweetest trading ever. For the low hanging fruit, which is going to be most of your trading right now, and this is again very easy to achieve and yet very profitable, what we're going to do is same scenario, but we're going to move our stop to break even when the market reaches the 75% of this implied dealing range. And the reason why we care about this 75% of the implied dealing range is because if the market goes back into this range, then we know that the market is going to move higher without making deep retracements. And the reason why it is going to do that is because we do not want the retail traders to take their stop losses out as they get scared and they are going to pull their orders off. And this is why the market is going to be in a rush to go back above the levels of buy side. So we're going to trail our stop to break even, because if the market does a big retracement, then we know that we are in the wrong direction and we just go out at a break even, covering the costs of commissions. So in short, you're going to have some form of a low hanging fruit. You have some form of a 15-minute or a 1-hour target above, which is going to be your intra-session target. And then you're going to have the macro daily target, which is going to be some form of liquidity or inefficiency, which you want to see for the entirety of the day. The basic thing that you have to understand about this trade management is the 3 PDRA rule set. We're going to put our stop below the third PDRA. We're going to move to break even when the market goes into the 75% of the implied dealing range. So again, from the low of the range to the high that we're targeting that has not been materialized yet. And then you're just going to let it go. And if you have a position and the market goes above this, it is going to want to retrace because it's normal. So do not trail your stop too early. But if you want to be aggressive, you can trail your stop below. If we're going to trade here, make a swing high, below the third PDRA. Usually it's going to be a fair value gap, and then some form of an order block. So you're going to have your stop here. The market is going to do its thing. Use the order block. This is going to be mostly a balanced price range because this is a higher time frame balanced price range, right? We went into some form of a higher time frame level and then we left it. So on a higher time frame, the market has done its job. This is why I tell you to trade exactly in the way we trade, right? This is why this one directional view is so good, because everything aligns. And if everything aligns, this happens, right? So let me just put the quality to HD. I think it's HD already. Let me just go in and speed up a little bit. So this is the NQ Futures launch execution. I don't know if this example is very appropriate to the risk management that I want to teach you right now, but let me just make you understand how to place your stop first. So what I'm buying here is, I'm going to buy this inversion gap shaded in white, looking at the 1 minute chart in the right. I also want to highlight the fact that we can see the market clearly wanting to go above this level of buy side. This is also level of buy side from the New York AM session. This is exactly our model, which is lunch session 6 a.m. and PM takes lunch essentially. But we have the low, the high, 50% is going to be here. We want to target some form of a premium. This high, the fair value gap high. And ultimately some form of a standard deviation above this. Let me just go long. I went long into the immediate rebalance. And this fair value gap here, okay, fair value gap. And then ultimately I would want you to have your stop below the 50% of this order block. So ignore my stop loss. This is because I am, first of all, exactly what I told you. Fair value gap, we left it. So therefore, I anticipated the fact that we're going to go above this. So this would become a balanced price range, which I will later go on and annotate as a balanced price range. But I longed, I wanted to see this as a breakaway. But for the teaching purposes of teaching you how to place your stop, first, fair value gap. Second, because this is very tight, is going to be the order block high or the order block opening. And then the third is going to be the 50%. So my stop loss in this case, because again, this is very tight, it is going to be below the order block. Or if the market wants to go into the 50%, I would place it at the consequent encroachment of this tail, or even for this swing low. And I'm targeting a very easy target right here. Let me just annotate this. Exactly what I saw. Balanced price range. Immediate rebalance. As you can see, I want to see the market go higher with speed. Annotate it as breakaway gap. Exactly what I've told you. We ran away from it. There's no reason for the market to go back into this range with a deep retracement. And what I'm doing when I'm looking at this trade is I'm constantly measuring how the market is moving, right? So I'm looking at this here, this mitigation block. I want to see the market reject it. I don't want to see the market spending a lot of time in it. And let me just show you. Exactly what I said here, BPR dealing range for this one. What I'm doing here is I'm adding standard deviations, and my target was successfully met. So this is an example with the low-hanging fruit. Let me show you an example with the macro daily target, which is very, very easy trading. So let me just give you the perspective right now. This was in the 15th of May. I know that you are already sick of this trade, perhaps, but this is a very, very good example in terms of how easy it is to trade instead of this perspective. Right here, this is the CPA day. This, I want to tell you that this was exactly at the 75% of the implied dealing range instead of a daily chart. Think about it. So inside of the daily chart, this day was at the 75% of the implied dealing range. So this daily April buy side liquidity, this was so easy to achieve. Like we were so close to it. It was so easy to see that the market is indeed going to go for this. So this was our macro target, the daily target. Look at these levels of sell side here. The reason why we do not see this as relative equal lows, and the reason why we want to see these lows stay in, is because the market is in a such degree of, it is very bullish, and we want to see this being taken. And when I say very bullish, it is so obvious that the market is going to go for this high. So these are going to stay in. The market has retraced beautifully inside of the fair value gap, which was made throughout the 830 CPI. And what do we want to see prior to a big move? We want to see the market go below a level of sell side for the smart money accumulation. Market goes back into a discount. This is exactly what I want to see. 950 to 1010, taking the pre-market minor sell side liquidity pool, or the 830 CPI sell side, and you can see the market creating a swing low, running away, closing above the consequent encroachment of the 1 minute wick. You can use this as a means of an entry. I'm not that advanced yet to use this type of entry here because the market can create another run lower, and this is based on time, but I'm not going to get into that right now. You can see how I see this as a breakaway gap, and my model of entry is utilizing an inversion gap. So I can use a fair value gap just as good, but I like to use inversion gaps because I like to get in before the market structure shift. Market goes back into this. I longed it, and your stop loss would be as follows. Let me just see what the market does right now. Good. Entry, right? This is your first PD array, second PD array, and the third auto block. Exactly as I told you. Stop loss would be below this. And ultimately, we would not even want to see the market go into the lower half of this inversion gap, but your stop loss would be here. Exactly what I have it placed, right? But I just want to, your stop loss is going to be lower. And the reason why, let me just give you some insight. Reason why I placed stop loss here is because we've also had, look at this here. Is there any inefficiency here? No. So this is also balanced price range. Market goes below a level of sell side. Smart money accumulation. So if they left this price action, they do not want to go back here. Your entry is going to be here. Market has this low, this high. You can see that the market has room to get there. So if we're going to put the fib from this low up until this high, it is going to be an implied dealing range, right? So what we're looking at here is this is the low-hanging fruit. This can be named as the intra-session target, and this is the daily target. In this trade, I have targeted the intraday target, but this was so easy to see. Swing low instead of a fair value gap, and this is what I'm looking at when I'm looking in a trade. I want to see the market go higher right now. We closed above the 50% of this wick. Want to see this used as a means of a support. As I've told you, the market is going to only stay in for 2 minutes. Remember, 2 minutes. If it's going to be extremely bullish. auto block. And when the market goes back into these speed arrays, I'm constantly measuring. If this fails, then I want to see this repulse price higher. If this fails, I want to see this, and this is my last line of defense. If the market goes down below this and it closes below this, then I will cancel out and I will try to save my stop. I'm not even thinking about the profits anymore. Immediate rebalance. So I want to see this as a means of a breakaway because this is a sign of speed. And if this is left open, this is also a sign of speed. This now should go higher with speed because this is an immediate rebalance. And let me just, right here, if you were to target this, or even this one here, you're going to put right now your stop loss to break even. Right now instead of this candlestick. Low to this. When the market, look at how it correlates, right? From this low onto this target, the 75% will be around here, which is exactly the rule set that I've also gave you with a minor buy side liquidity. So again, if the market goes above a level buy side or inside of the 75% of the implied dealing range, it is going to be your stop loss to break even. What I'm looking at here, looking at this breaker, I want to see this as a future breaker, right? A breaker is only when the market closes above it. But I already see this as a breaker because this is so easy to achieve. Auto block. Right now I'm looking at this. I'm looking at this. And ultimately, I would never want to see the market go below the 50% of this, which correlates with the break-even theory, right? 1. Let's see if the market goes above from this. Takes the level of sell stops, fair value gap. Swing low. Right now, what I'm looking at instead of this candlestick is I want to see this as a future auto block. I know that I've talked about this with you. You're the only student that I've talked about this with. I'm looking at this. So if I want to see this as an order block, then I'm going to want to see the market go above this high. And if I want to see the market go above this high, I'm going to measure 50%. And if the market closes above the 50%, what do we know? We know that the market has now, the market is going to be more likely to go into the high. If the market goes above the 50%, we want to see the 75% and the high. And also notice that in here, the market never closed above the 50% of the future breaker. Right? We can see how the market uses this inversion gap. And right here, I told you that I have the tiger by the tail. And I've also said that I always teach my students to be highly selective of trades. Less is more, indicating that I already see this happening. And having a tiger by the tail means that I already knew that the market is not going to go into my stop. And I know it's a lot, but stick with me. Look at the 15-minute chart. What is this? A swing low. The market has successfully created the swing low. So it means what? If we want to see this balanced, then the market has to go above these highs. And we've already left the fair value gap. So there is no reason to go below this. And the market has not even went into the 75% of this tail. So what does the 15-minute chart tell me? The market is very bullish, very strong. I want to see this candlestick close above the 50% of the breaker. We closed above it. I want to see it being used as a means of support. And let me tell you what I also see here. I see the market expanding, making a retracement. Remember the algorithmic phases. And as soon as we've made this swing low here, I see already the market expanding. Retracement is done. The retracement was done for the sole purpose of going back inside of this fair value gap. We rebalanced it, and now we leave. So this is what? An expansion. If it's an expansion, then I'm looking for what? Auto blocks. So expansion, retracement, and now expansion. Swing low, boom, auto block. Closing above the 50% of the breaker. Let's see. Closing above the 75%, going to the high. I would want to see this as a breakaway gap. Candlestick with speed. This is now what? Market went higher, retraced back into a fair value gap, and we leave it. The sole purpose of this retracement was for this fair value gap to be rebalanced. This is now a balanced price range. So the market should not go inside of it with high degrees of retracements. Exactly what I've written here. We want to see the market use this breaker, and we can already see again, if we do not want to see the market go back into this here, right? Then what is going to be this? It is going to be a breakaway gap. We want to see it open because we want to see this not having deep retracements. And going back to our stop discussion, if we're aiming for this, then we're now at break even. And if you want to raise your stop more, you're going to have it at this here. Pay the trader to take profit, and look at the stop. 75%, look, from here to here, 75%. What do? Look, trail my stop. Below what? Of course, you can go break even. I just put it there. Swing low. So if the market goes there, I want to be out. Risk removed. This is the terminus. So we do not even need this target. This is where I want to pay myself. And imagine this level of precision. You do not even care about the money in itself, bro. With this level of precision, if you can see this once a week, $250 per week. This is going to transform into $2,500 per week, and then $25,000 per week. And look at how beautiful and how it is literally an art once you master it. And you're never going to actually master it, but once you get very, 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 very good at it, look at how beautiful this aligns everything. What do I have here? From this buy side to this buy side, 25% between these levels, 50%, 75%. I've taught this to you inside of February, right? What is this? Auto blocks. Why did I tell you? Expansion, auto blocks, right? Breakaway gap. Auto block again. I'm looking at the 50%. What I'm doing right now, again, I'm constantly measuring 3 PD arrays. And the market is now in that stage where I've told you that it can retrace and take out a swing low as a means of sell side because we went above a level of buy stops. So why don't we trail our stop here? This is why. Breaker. Fair value gap high. I'm going to remind you that the breakaway gap has to have the lower part open. It does not only require for it to be fully open. You can see how beautifully the market retreated back into the breaker high, right? So this is very strong. The market only touched the, look at how beautiful this is, BPR dating range. The market only touched the fair value gap high. Look, again, swing low, right? We have done the purpose to retrace back into this fair value gap here. What's next? Expansion. What am I looking for? Auto block. I want to see this as a future order block. So I want to see the market go above this high here, right? 50%. I'm looking for the market to close above it and use that 50% as a means of support onto sending price higher above this, making this, after we trade above it, an order block. And I'm also looking at these levels. If we see the market closing above the 25%, the market is going to go into the 50, and so and so. Order block, look at this. Also immediate rebalance. 50% of this, exactly as I told you. Look at this candlestick. Just try to imagine from this to this. 50%, we close above it, we do what? Boom, goes back into it. Closes above the 50%. Where does it go? 75%. BPR dealing range yet again, and this is my take profit. If I was right now to aim for this, what I would do is we took this beautiful profit. What I would do is the following: 1, 2, 3. My stop would be here. Trail right here or even below this. Because the market, we can see, is very strong. And also look at this, right? This is a BPR dealing range in itself inside of the 15-minute chart. But I'm not even going to talk about more things right now because I know that there's a lot of things in your head right now. But I've told you this is going to be crazy within this year, right? And you're going to know how to do all of the things that I've told you today. And I hope I made it clear to you how beautiful this rule set is. And also, let me tell you about the rule set that we used in terms of the 3 PD arrays, right? I'm going to tell you about this in reverse. And I know they already know this, but I'm going to repeat myself because why not? It isn't bad to remember. Of course, look at this, right? Let's look at it from a different perspective. What is this? Immediate rebalance. The market failed this immediate rebalance, right? If the market doesn't go lower with speed, then this is going to be either what? A market reversal or a market consolidation. Fails. 1, 2, inversion gap fails. 3rd, of course, you're not going to put this as a PD array, right? But this is something that you're going to know. So 1st, 2nd, and then the 3rd. This fails. What does this mean? That this has successfully failed. So this also gives us a very good confluence. Right. Let me just shock myself with how much this was because I don't know how. It felt like 5 minutes for me, G. 1 hour. Dead.